Hey everyone, welcome back and thanks again for joining me on the Financial Management for Small Business training. In this session, we're going to be talking about how to read your financial reports. And now, as I mentioned in the last session, on cloud accounting software, this needn't be a stressful or complicated thing for you. If you don't consider yourself a numbers person, then never fear, I'm going to be explaining this in easy to understand terms. This is just a disclaimer, the information provided in this presentation is general in nature only, and it doesn't constitute personal financial advice. So flying blind is a favourite little saying of mine that means that if you don't read your financial reports regularly, and if you don't have a cash flow in place or a future plan for your business, then basically you can be just winging it and flying blind a little bit. So what this means is that you've got no gauge or measure to determine how you're doing in business and whether you can afford things or not. And many business people don't love numbers, I understand that, and they don't like looking at their financial reports, and they struggle to understand the information on the pages simply because they've never been taught to do so. So I'm on a mission to change that through education programs such as this. Now, when I talk about profit and loss or a balance sheet or debtors or creditors and gross profits and trading statements and depreciation and things like that, most people are going to cringe. You're going to feel out of your depth and you're simply just not going to know what a lot of those things are. But that's okay. I'm here to help. So what are the reasons that we should be regularly, reviewing our financial reports as a business person? Because it helps us to become aware of where you're sitting financially. You'll feel more ease, you're going to feel more in control of your business if you're able to see these figures and you can make changes when necessary, and it prevents, things like little surprises coming along, like large bills from suppliers or the tax department, and you don't know where you're going to get your money from to pay them. So most people clients that I start working with only look at two reports or two figures in their business at any given time. Now, can we guess what they are? Most people say to me, I look at debtors, who owes me, the invoices I've sent to customers. We probably know what that number is. And a bank account, what's in your bank account? How much cash do you actually have? And why is this so? Why is it that a business owner may only look at two figures in their business? Perhaps because they don't understand what the other numbers are. Perhaps because these two numbers are easily accessible. They know where to look for them, and they might have them swirling around in their head somewhere, because you can just get onto your internet banking, you can go on your phone and you can see your bank balance in a heartbeat. So that's not too hard to do. But why are those two numbers, the debtors and what's in your bank, not a good indication of where you are at in your business and how you're traveling financially? Because they only tell us what's happening right now, in that moment, what you have right now and what you're likely to receive in the next 30 days. It doesn't take into account other crucial factors such as taxes coming up, expenses and other liabilities which will be coming up, such as loans. Some industries may also look at creditors, what you owe to other people in terms of materials or goods that you buy on credit. So today in this session, I'm going to go through the 5 reports you should be looking at and in your business, and extracting each month from your accounting software. So you've got clarity about how your business is traveling at any given moment. Okay, So as you can see on the screen here, we've got a profit and loss. And this is just an example of a small little city cafe. It's a full 12-month profit and loss. But ideally, you want to be looking at this sort of report on a monthly, if you're a bigger business, a weekly basis would be best. And this report tells us whether or not we've made a profit for that given period of time that we're looking at. And it's got the total income up the top and the total expenses down the bottom. Fairly simple. But the numbers that we should be paying close attention to in this report is the percentage of certain expenses as they relate to sales. So example, a cafe, we'd look at the total cost of goods, or the total cost of sales in this instance of food, coffee, milk, packaging costs. Why? Because they're directly linked to the sales that they make. They might make breakfast, they might make lunches and rolls and things like that they resell. We'd also look at things like wages and rent, because those three things, especially in a business like this, are the three major or highest costs that they're going to wear in their business. And we need to really make sure that those costs aren't taking over the amount of income that's coming in. And as a general rule, wages and cost of goods shouldn't be no more than about 25 to 30% of the total sales. So the 428,000 we can see there, wages should be no more than about 30%, maybe 35. Cost of sales should be no more than that either. And rent, as a general rule, it should be no more than about 15%. It ideally would be around 10% or less. So in this instance, the rent is probably around about getting up towards 15%. Because otherwise, all of these costs are going to eat into our profits. And we need the extra income as well to cover all of the other costs, like the accountant's fees or the office supplies or the business insurance and those sort of things as well. And the next report that we need to be looking at in the business is the balance sheet. And this is an example again of this cafe's balance sheet. And this is a reflection of the health of a business. And it is a report that is often overlooked and misunderstood by many people, because unless you've done accounting in probably year 12, at least basic level, then you probably wouldn't be able to decipher this sort of thing. But the main thing we want to look at in a business's balance sheet is that the assets are greater than the liabilities. And this tells us the financial shape that our business is in. It tells us that we are not overcommitted in case the business and in this case, this one here, we have more assets than what we do liabilities. We have around, 167,000 in assets, and we've only got about 132 in liabilities. So our assets are outweighing our liabilities. So that's a good thing. So, an asset, as we know, could be anything from furniture, fixtures, it could be a car, it's the plant and equipment. And essentially those things make us money in our business. An asset, just like a rental property, should generate an income for us. And then obviously a liability is something that costs us money. So things like car loans, business loans, home loans. One might argue that there is good and bad debt, of course, but nonetheless, debt is debt and it has to be repaid at some point. And we need to have a solid plan in place for debt repayment as well. Your business is an asset, you may have the tangible assets such as the equipment and the buildings and things, but you could have an intangible asset in your business such as goodwill. What is your business worth? In this case, this cafe, ABC Cafe, could have a reputation and a good name and repeat business from repeat customers. And in that sense, there could be a goodwill component that is worth something to someone else to buy, to come in and take over that business and keep it running and make it work for them. So that's an asset too. And the balance sheet tells us, liabilities that are coming up too, such as, GST that we've got to pay on our BAS, our employee superannuation, credit cards, and creditors that are due. It also tells us, if we're running on this sort of system, the income that we expect to come in by the way of the total debtors that are owing, which we'll go through shortly. Now, don't get too scared by this, this report here. I know there's a lot there and you mightn't be able to see it all too well, but the third sort of report that we should be looking at or should be developing in our business is a cash flow forecast or a budget, okay? And this report can't really be easily generated from the mainstream accounting software packages. They can be to a point, but they basically need to be put together by a profit and loss and a balance sheet needs to be put together, and perhaps your accountant or advisor probably could do this for you. And this is what I do for my clients that I start coaching and working with is, before we do anything, we start with a cash flow and a budget so that we can project out how much they're going to be expecting to bring in and pay out in the next 12 months. So, as I said, this is a product of a balance sheet and a profit and loss being put together all in one, and it gives us the best overall picture of how much available cash we're going to have in the bank at the end of any given month, okay? It's also an estimate of budget or how we think that our business is going to do in the future. It helps us to plan for the future and it helps us to make educated decisions on things such as putting on more staff. We might want to buy more equipment and estimating yearly rises in expenses such as rent, electricity, or insurance, which inevitably always tend to go up. So this report is used in conjunction with a profit and loss and balance sheet each month. When you come to your management meetings with your manager's staff or your advisor, and we compare these figures to our budgeted figures to our actual figures, what we actually did during that month. Why do we do that? So that we can make adjustments where necessary. So we can answer questions like, can I afford to pay to put on a new staff member? Can I afford to buy a new car? Can I afford to invest in equipment, new computers, or move premises? This is how we answer these questions financially, by preparing a budget and a cash flow and then comparing it to what we actually did. So at the bottom there, you can see what the net cash inflows are and what the total expenses are, and then what was going to happen in our bank account, hopefully at the end of every month. And this takes into account, when we look at our profit and loss, that only takes into account our income and expenses. It doesn't take into account things like capital injections. So you might put some money into your business. That's not on a profit and loss. You might get some rebates or government grants, loan payments, taxes, owner drawings, and other sort of non-expense type things that would be on a P&L, that's in here. Okay, so in here we can see we've got directors' wages, we've got directors' super, and we've got loan repayments. So we know exactly if we're going to run into some sort of cash flow shortage, then we can project that out by using this sort of report. So it's extremely, extremely valuable. The next sort of report that we really need to be looking at is a receivables or a debtors report. Okay, so this report here is a snapshot of the debtors owing or the invoices that have been issued to customers that are yet to be paid. So it tells us the total amount owing by the customer or by all customers and the time the invoice has been outstanding or unpaid for. So in this case, 30, 60 or 90 days plus since we actually sent the invoice to that person. There's also what is called down the bottom there an aging percentage. And this percentage is the total amount due for the outstanding days. So in this case, there's 31.45% of the total debtors, so the total debtors due, have been outstanding for between 60 and 90 days, as we can see there. And the reason that we want to know these numbers is because the longer that these invoices go unpaid, the more strain it's going to be on our cash flow, as the money is not in the bank to pay for our other expenses. And again, this is a report that people probably look at and they might know, okay, I've got $67,810 worth of debtors, but if half of them have been owing for 90 days, then you are going to run into a cash flow shortage. So this is something that needs to be monitored. We need to have a debtors management plan in place. We need to have terms and conditions up front, depending on what sort of business. This is a blind and curtain business, which do run a lot of on debtors and creditors. But if you're another sort of service-based business, you could have upfront payments or monthly payments or something like that. So you need to really think about how you structure your customer terms. So this report here, the last one that we're just going to go through today, is a creditors report or a payers rule. So accounts payable as it's commonly known. And this is similar, similar thing to the way that the debtors report works, except it is money you owe rather than to others, rather than who owes you. So this is, in this case, again, this is the curtain and blind business. They obviously buy in components, they buy in raw materials to make their product. So again, we have the columns with the days outstanding, the percentage to total invoices owed, and how much we owe up until the given period of time, which in this case is the 31st of December. So when we think about these two reports, they effectively should be looked at together, right? Because as the money coming in has to cover the money going out, and if we have a big time lag from one to the other, like we're paying creditors at an average of 30 days and receiving debtors at an average of 60, we're going to run into a cash flow shortage because we're paying out before we're receiving. So it's important to be monitoring this regularly and also using the cash flow forecasts to future plan and to estimate in advance what we're going to receive based on history and expectations. So just to cover off today, what we've learned is profit and loss, income less expenses. This is probably, if you don't look at anything else, look at this one, because this will tell you whether you're making a profit. But the point being with this report is that we need to go, okay, now where has that profit gone? And the way that we do that is that we look at our balance sheet, because you might have made a profit of $50,000, but you mightn't have that $50,000 in the bank. And inevitably that's gone to pay things like loans or your own drawings or other things that don't appear on the profit and loss. We looked at the importance of a cash flow projection or a budget, because this helps us make future decisions. It helps us to gain clarity in our business. It helps us to be confident in the financial decisions that we're making in the business, because otherwise, getting back to my first comment, we're just flying blind. We're just guessing, and we don't want to do that when we're talking about dealing with our business, our livelihood, and potentially hundreds of thousands of dollars. Fourth report is the debtors owed and the days outstanding. So it's not just the debtors that the customers that owe you money, but how many days on average have they been outstanding? And we can get other reports out of our accounting software that tells us, say, over a 12-month period, what the average days outstanding is. And this is, again, an important report to be looking at, because if we've got 60 and 90 days, we need to put some plans in place to get that down. And the final one was creditors owing, payment and payment days. You need to also have payment terms. Your creditors, people that you buy goods and services from, also have their own terms and conditions, and they might want things paid in 7 days. Other people might want it paid in 30 or 60. So we need to make sure that our debtors and creditors payments are on a par so that we don't run into cash flow shortages. So thank you once again for joining me, and I will see you again in the next session. Thanks so much.